This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. I've got a special guest today. Dan Ives is a managing director of equity research at Wedbush Securities, and we're going to talk technology investing and what those two things mean together, both the revolutions in technology and how to make money from them over the long term. So he'll be coming up in the second half of the podcast, and so make sure you catch him. He's also got a cool prediction list. Investment firms and strategists always put out their New Year predictions, and he's got a good one, tech predictions for 2020 that I'll sample quite a bit from. And I just want to share one interesting thing. On January 3rd, he had to put out a note because we just had an incident in Iran. We did an airstrike on General Soleimani, and that was sort of a risk-off moment for the markets. And so he just wanted to send a note to his clients, letting them know, where he stood, what that meant for any kind of hiccup that was coming in markets. And I really love what he said at the time, about whether the momentum in stocks, would take a big hit, because only a few weeks before he had predicted a significant rally in technology stocks, 5 to 7% rally, and we were already well in the middle of that. And he wrote, "It's a complicated question, but ultimately we continue to believe the scarcity of growth assets in the world keeps leading us to a unique combination of transformational secular growth trends in the tech space for 2020 that will drive stocks and valuations higher despite last night's events." And he wrote that on January 3rd. This setup for 2020 is set to be a robust one for tech stocks, and we would be using this morning's weakness to buy our favorite secular growth plays for cloud, Microsoft, 5G, Apple, and a few other names in cybersecurity he mentioned. I'll just mention those two big ones because Dan has basically nailed the huge returns that you've seen in the past few years in both Apple and Microsoft. All right, so Dan Ives coming up in the second half. Start off talking about some more interesting things I've been up to lately. I'm reading a fantastic new book right now called The Map of Knowledge, a 1,000-year history of how classical ideas were lost and found, by Violet Mahler. She's a British scholar, actually sort of an independent scholar. She wasn't a professor of history or literature or philosophy at a major university. She independently grew her way into that, and you can find out more about her at her website, violetmahler.com, Moller. And actually, I'm listening to the book because it's written by a Brit, but also read by an equally British reader who is likely unequaled in her ability to pronounce the very long names of Persian and Arab kings and scholars that frequent this book, since it's about that 1,000-year period from 500 AD to 1500, when, that we've often called the Dark Ages, and when many classical books were lost, and how they were preserved, and what that legacy is. Let me just read the description of the book. After the fall of Rome, when many of the great ideas of the ancient world were lost to the ravages of the Dark Ages, 3 crucial manuscripts passed hand to hand through 7 Mediterranean cities and survived to fuel the revival of the Renaissance. The foundations of modern knowledge, philosophy, math, astronomy, geography, were laid by the Greeks, whose ideas were written on scrolls and stored in libraries across the Mediterranean and beyond. But as the vast Roman Empire disintegrated, so did appreciation of these precious texts. Christianity cast a shadow over so-called pagan thought. Books were burned, and the Library of Alexandria, the greatest repository of classical knowledge, was destroyed. I'm just going to have a Kevin Cook note here. When I look back at history, I mean, there have been tragic losses and wars that, make us feel certain ways, and rightly so. When it comes to knowledge, it's like sometimes I am dumbfounded by the loss of the library at Alexandria and what was lost. And it's so it's really, that's why I love this book by Violet Mahler, The Map of Knowledge, is because she basically goes back and details what was lost, but also what was preserved and found again. All right, back to this description from Amazon on the Map of Knowledge. Yet some texts did survive, and the Map of Knowledge explores the role played by 7 cities around the Mediterranean, rare centers of knowledge in a dark world, where scholars supported by enlightened heads of state collected, translated, and shared manuscripts. In 8th century Baghdad, Arab discoveries augmented Greek learning. Exchange within the thriving Muslim world brought that knowledge to Cordoba, Spain. Toledo became a famous center of translation from Arabic into Latin, a portal through which Greek and Arab ideas reached Western Europe. Salerno, on the Italian coast, was the great center of medical studies, and Sicily, ancient colony of the Greeks, was one of the few places in the West to retain contact with Greek culture and language. Scholars in these cities helped classical ideas make their way to Venice in the 15th century, where printers thrived, and obviously the Renaissance took over, and the rest is history. The 3 texts that the Map of Knowledge follows are Euclid's Elements, Ptolemy's The Almagest, and various writings of Galen on medicine. And I guess I had no idea what a prolific writer Galen was on medicine. And so the fact that these things were preserved was an amazing benefit to Renaissance investigators of all things natural and biological. So the book was just full of wonderful discoveries and sort of perilous journeys of driven by insatiable curiosity and the thirst for knowledge, that existed in the cradles of Western civilization. Like so many things about Baghdad, ancient Baghdad, that I learned. One little gem that jumped out at me in chapter 4 or chapter 5 was the word algorithm has its roots in the sort of the Latinizing of the name of the Persian mathematician who I believe is responsible for algebra. So you can see the connection between algebra and algorithm. But here are the key details. So the Persian mathematician, his name was Muhammad ibn Musa al-Khwarizmi. On my first try, not too bad, huh? This word was developed algorithmus. And that's sort of what it became in late medieval Latin. And in English, it's algorithm. So that's sort of the evolution or corruption of his name, which simply later meant decimal number system. And the word algebra itself stems from the Arabic word al-jabir, which has its roots in the title of a 9th century manuscript written by that mathematician, al-Khwarizmi. All right. And I guess the English translation of that book would be the Compendious Book on Calculation by Completion and Balancing. Or the Compendious Book on Calculation by Completion and Balancing. And it was a pioneering work offering practical answers for land distribution, rules on inheritance, and distributing salaries. All right, now speaking of algos, there's another book out there that's much more popular, and that's the one about Jim Simons, the founder of Renaissance Technologies. And the book is called The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution by Gregory Zuckerman. And I learned, I don't know if I'm going to read this book anytime soon, because I've watched a lot of lectures and interviews with Jim Simons. So, and I used to follow him as an investor because he was so successful. So you would look at his 13F filings and see what he was buying or selling. And he actually stumbled into markets. He was a math professor in the late 70s and sort of stumbled his way into investing, where he had some family money. He was doing it on his own. He was successful, and then he wasn't so successful, and he realized he really needed to apply math to to markets, and he found, got together with some of his buddies, and he found how, with all the data they could get, the different things that they could do in financial markets and with stocks, and just slowly that evolution built, obviously with the help of better and better computing power and access to more data through the 80s and 90s, to make Renaissance some incredible returns for clients to the point where I think at one point they could charge, a typical hedge fund charges 2 and 20, which is a 2% management fee and 20% of the profits. He got up to charging something like 3 and 35. I think they could ask investors for 35% of the profits because they were so successful. They could turn investors and money away. That's how the demand for his consistent services was doing. And I remember reading about him and listening to him that, all he was interested in was hiring good quants. He didn't care if they had any background in markets. In fact, he probably preferred that they didn't in some cases. And he just wanted the rocket scientists, the engineers, the quantitative people who could build models, understand data, manipulate data, and mine it, and model it and make use of it. And and that's the powerhouse that Jim Simons created. So if you're interested in that story, then I recommend Zuckerman's book, The Man Who Solved the Market. It just came out late last year, and you can probably find an interview with Zuckerman on YouTube also, where he talks more about it. So as people talk about algos running the market, well, they do, and they sometimes beat each other up too. They're not just taking advantage of small investors, but here was the origin. It was the work of Jim Simons and all the math quants that he surrounded himself with. All right. When we talk to Dan Ives coming up here in the second half, he talks about the 5G supercycle. And you've heard me talk about the technology supercycle, which I saw with all these different areas, from mobile and data centers and autonomous driving and robotics and artificial intelligence, that was just driving creativity, innovation, and then demand for new types of semiconductor chips, new types of computers, NVIDIA with parallel processing, new types of software, and that this was beyond anything to do with the next recession or the next PC upgrade cycle. That this was a big secular revolution that would continue well into this decade. And you're going to hear Dan confirm a lot of that. So in the article version of the podcast on Zacks.com, I'll have a link to my 2017 thesis called The Technology Supercycle. All right, and the last thing I want to talk about in this first half is another, not an investor, but a student and professor of technology disruption. And his name was Clayton Christensen. He wrote a book in the 90s called The Innovator's Dilemma. And then he just spent the next 20 years, almost 25 years, talking about technology, innovation, and disruption, and what it meant for incumbents and new companies and society and the evolution of technology. Well, I just found out he just passed away in January. I had known of his work. I actually have a book of his that's about education called Disrupting Class. And I'm going to spend some more time with that book this year to learn more of his ideas about what he saw in education, or the opportunities to disrupt education. And so I just stumbled across an MIT Sloan interview with him that was done by one of his collaboration partners, somebody who's written books with him. Let's see if I have her name here. Yeah. So she had done the interview with him in Q4, and I didn't know if he was ill or not, but he did pass away in, I believe, January 23rd. And so I just wrote this note to my people last night. I said, Dr. Disruption left us with lots to chew on. I just found out that Clayton M. Christensen the researcher who did some of the most important work on disruption in business, passed away in January. I found out through a Q4 2019 interview on MIT Sloan Review conducted by one of his research partners, Karen Dillon. Several interesting insights stand out in the discussion, including how Clayton admits one of his biggest blind spots was missing the early success of Apple with the iPhone. If you just do a search for Disruption 2020, an interview with Clayton M. Christensen, and it's on MIT Sloan Review, you'll find it. And so he talks about that mistake. He also talks about his approach to analyzing industries and companies. And here's a short response that characterizes how he says you have to identify disruption by looking outside the traditional data and outside the vested interests of incumbents. So this is quoting Clayton Christensen. As an example, in my early research on the disk drive industry, I cataloged by hand every disk drive that had been bought or sold over the years after scouring hundreds of disk trend reports. And while I was starting to see a pattern of the low-end companies quickly rising to prominence and challenging established leaders, it wasn't until I went out to Silicon Valley and spoke with executives in the space that I fully grasped how incapable incumbent leaders are of responding to disruptive entrants. The data alone would have never generated those insights. I think that's such a powerful thing right there, and it applies to so many industries. And I'll give you an example with Tesla that I've done some content recently on Tesla. I've done videos, podcasts, articles, and I always give credit to Ron Barron, an investor who has a family of funds eponymously named Barron Investments. And he was an early investor in Tesla, not right at the IPO, but in 2014, he built a 1.6 million share position at an average price of $219. So, and that comes out to just over $350 million. And that's probably was his marker. He wanted to put $350 million in Tesla. That's what he did. He's never sold a share, even with the recent run up to 950. And I just saw an interview with him a couple of weeks ago. And actually, February 4th on CNBC, I saw him. He was on Squawk Box. And since he was on there for an hour or whatever, he got a chance to really flesh out some ideas. And he talked about their research into Tesla. And he specifically talked about the incumbents in the auto industry. And he said, what you have is you have GM and Ford and Daimler and Volkswagen and Toyota who have billions and billions of dollars invested in factories that make the most expensive part of a car, which is the engine. Now, you might start thinking, well, sunk cost, right? That's their business model, that's their investment, and it's partly true. That's to all of a sudden, get out of that business would be extremely difficult and upsetting to many other businesses in their web. And the other thing he pointed out is dealerships. He said, dealerships make their money on service, not really on selling new cars. And so they have an incentive to stay with the old model. So there is an example of some incumbents that will be slowly disrupted in this decade, and it'll be exciting to watch. All right, when I come back, we will hear from Mr. Ives of Wedbush and learn about his new street high price target for Apple shares and why he views it the way he does. And we'll talk about several of his hot 2020 predictions for technology in this decade. All right, I will be back faster than you can spell technology innovation supercycle. Today, my guest is the Managing Director of Equity Research for Wedbush, Dan Ives. Dan was a standout voice among analysts in 2018 and 2019 who said to stay extremely bullish on Apple, for one thing, And I remember in October of 2018, he had a $310 price target, which was the street high, and shares were trading just above 200. Apple took a little detour in November and December of 2018, as we all know, or as investors who were paying attention noticed. But we're finally there. We're finally, this is a $320 stock now, and on its way higher. We'll talk about Dan's new street high price target and how he does the math. We'll also dive into his 2020 predictions, which I find the most interesting of any investment firm. Before we meet Dan, a little about Wedbush. Wedbush Securities, privately held financial services and investment firm based in Los Angeles. The firm was founded in 1955 by two high school friends, Edward W. Wedbush and Robert Werner. They each contributed $5,000 to capitalize their new venture, Wedbush and Company, which took Edward's name after he lost a coin toss. He remained president for 63 years. Dan, welcome to Mind Over Money.
That's great to be here. Thank you.
Hey, I know your office is in New York City, close to the heartbeat of capital markets, but I've always wondered if Wedbush, as a unique LA-founded investment bank, has a disproportionate access to Hollywood wealth management clients. Do you know anything about that, or are you privileged to say or not say?
I mean, look, I think, as a firm, we've been very successful really around the country. Obviously in the West Coast, especially, was our presence. But I think that's really been a big part of our success over the last few years, expanding across the U.S. and even in New York, where we have a big presence. And, it's great to be a part of a company that has a vision like this.
Yeah, very nice to see that kind of growth in money management for a firm. It's been around since 1955 and staying private. Let's talk about Apple first. And I want to go back to 2018 with that big growth hiccup that seemed to scare a lot of investors. I mean, the shares were above 200 in October of 18. You had the $310 price target. But what made investors run for the exits when they reported their fourth quarter results, which is right before the holiday quarter, which is their fiscal Q1? What was going on then?
Sure. I mean, look, that, in my opinion, covering Apple, really since the iPhone launch, that was one of its darkest days. I mean, it was really about China. The China growth fell off a cliff. You had some product cycles in terms of 10, and an XR, even the next one, that were not successful. And investors really viewed it like the growth was done in Apple. And, and our view has always been the stock, you have to look at the install base and the upgrade cycle. You could go through these peaks and valleys. Now it's obviously a huge valley. But if you saw the sort of math that we talked about, the install base, 900 million plus iPhones to date, 325 to 350 million of them were in upgrade cycle, it was going to come back. And that was really our call, combined with the services business that was going to start to get re-rated. And that's all, along with great execution, got us where we are today.
Yeah, and I can confirm that's where you were in December of 2018 when things were looking dark. I went back and I found on YouTube, an interview you did on CNBC with Melissa, and that's what you talked about was the installed base, and that there was going to be this growth hiccup where people were throwing the baby out with the bathwater, but longer term, things were intact, and we'll come back to that in a minute. I also noticed that you seem to have a habit of raising your outlook before the company reports, like a couple of weeks before the company reports, and you just did that on January 23rd with the move to a street high price target of $400 on Apple shares. And it's almost as if you see things in your outlook that others are missing because they'd sort of rather wait and see what the company delivers, like they're on pins and needles. So what's involved in your decision and your process?
Yeah, no, and thanks for pointing it out. And obviously last week, Uber, earlier in the week added to a top pick before they came out with those numbers and the profitability in stock. It's had a nice move. 20 plus years doing this as an analyst. I mean, my job is to kind of find the trends earlier. And handhold clients, sometimes through rocky times, other times through smooth times, and where you should maybe sell these names. And I think we just try to do a little more work, than maybe some others out there to try to make the calls. But because I find when you make the calls after quarters or after moves, that's sort of not our style. Our style is to try to find these things early and to try to stick with them through thick and thin if we believe in the thesis.
Right. Yeah, and you definitely did that. I also saw another interview you did just this December, December 16th on CNBC, where you were calling for a big rally in tech into the new year. You were, we had just had Friday, December 13th, which you sort of saw as a watershed in the tariff wars. That that was firmly off the table. The market was sort of telling us, in Q3 and Q4 that investors didn't care about the trade war, but that December 13th sort of marked the time, and you called for a 5 to 7% rally in technology. Hey, we're up 12% on the NASDAQ 100 since then. Well, what should investors be taking profits here, or what do you think?
Yeah, and look, and my whole view throughout all of last year was, in terms of the tariff issue, that was the one event, the one core risk to the tech rally.
Okay.
And once the two came to the table and that got taken off, in my opinion, you'll have events just like we're seeing Corona and some other issues. But to me, I think we still have a good 18 months left to this tech rally in terms of where we see it. And I'd almost go a step further. In covering tech for decades, sometimes there's good trends that are definable. Other times it's just you're making calls on stocks, good and bad. I think there are some of the most definable technology trends I could ever remember seeing in terms of 5G, supercycle, cloud, in terms of where that's moving, cybersecurity, and some of these other areas where, I believe tech just has some massive tailwinds around it going into the next 12 to 18 months.
Yeah, it's good to hear that. And I just looked over your top 10 tech predictions for 2020, and we're going to talk about a few of those in a minute. I just want to close with Apple, because Apple is so symbolic of something that I talk a lot about here on the podcast, and that's having a long-term view of the trends and not getting shaken out by the temporary, if Apple can't make its, year-over-year comps, it's a 3-alarm fire to some people. It's like, oh my God, is it peak iPhone? And we're going into a permanent decline. But if you step back, you can see that, we're not at peak iPhone. And you talked about the installed base driving the services. We peaked at 265 billion in 2018 on a 12-month revenue basis, and that appears now just to be a temporary plateau. So, what, in your view, drives Apple over $300 billion in sales next year?
I mean, to me, it's about the 5G supercycle.
Okay.
If you combine that with services, that's why I think it's a stock that has a 4 in front of it. In terms of just those dynamics, especially with China. I mean, China is a big part of the growth for Apple looking ahead. And to me, you could have bumps along the road. You're always going to have bumps. When I look at Apple, I continue to view it as, why it's been our favorite name, for many years, in terms of where they sit on the growth profile of smartphones, services, and really about a stock getting re-rated. And that was a key part of our thesis, and it continues to be.
Yeah, I mean, if it goes to the first $1.5 trillion stock, you're paying 5 times sales, but it's some of the highest quality growth on the planet, obviously.
Exactly, and we continue to think, it's a $2 trillion market cap.
Okay.
By the end of 2021.
And this is what I love about somebody with a long-term view of the secular trends, technology trends, is that you keep your investors in the stock, even during those rough times, and then you realize this long-term value. And I'm sure many of your clients are very happy with you keeping them in the stock. Now that we're, it's trading 320 and it's on its way to 400.
And even to that point, I would say, let's say Uber. Okay, our hard work in Uber is when the stock's at 26, 27, feels like it's going much lower.
Okay.
When that stock starts to rally, and now you're looking at a stock $40 plus after good earnings and profitability. A lot of our clients, they don't need us as much once the stock starts to work. It's during those rocky times where I think we've always viewed ourselves as most valuable.
Yeah. Currently, though, do you like Lyft better?
Look, I like, in terms of the longer term, we like Uber just because more of the global, some of the parts, Amazon or transportation thesis. But we do really like Lyft. It's domestic. I think the valuation's attractive. And I think ride sharing, that's going to be a space in the stock that gets re-rated. And which is why we continue to like the space. But, especially after the move that Uber's had, continue to like Lyft here significantly.
Okay. All right. I want to go through 5 of your top 10 tech predictions for 2020. Number 4 is Microsoft and Satya Nadella will win the next stage of the cloud war versus Amazon and Bezos. Why is that?
I mean, I think they are extremely well positioned on this next phase of cloud in terms on the move to enterprise. Amazon and Bezos won the first part of cloud, and on this next step, and I think you've seen it in the growth numbers from Microsoft. I think they win this next step, which is why we continue to be very bullish on the name. That continues to be our top cloud pick going into next year.
Yeah, and I want to mention that you have been a long-time bull on Microsoft as well, just like Apple. I looked back at some of your prior notes, and you were keeping investors in it at $100, and I'm sure they're very happy with that now at 190, new all-time highs today. Prediction number 3 was about Tesla, that Tesla will find success in China with Giga 3 and potentially hit the key 100,000 delivery number quicker than the U.S.-Europe trajectory, and that will be a demand tailwind.
Yeah, and I think that's played into a big part of the rally we've seen over the last few weeks. Of course, there's technicals and a short squeeze for the history books, but in terms of China is the linchpin of growth for Tesla. Continues to be the core thesis there, which is why 710s are base case, but $1,000 bull case based on China, and Giga 3 is the linchpin. And I think if you look at demand in China, it could be 4 or 5x what it is in the U.S.
Yeah, my eyes were opened to Tesla in January, and not just because of the explosive rally, but because I started listening to like the CEO of VW, Herbert Diess, said, you got to look at Tesla like a tech company, and that means it's a different valuation. Maybe you can pay 3 or 4 times sales. So and this valuation right now is sort of exceeding that, because even if you go out to next year and they do $40 billion in sales, 3 times that is only $120 billion market cap, and it's trading over $150 billion. But is that the new math for value in Tesla? Is as a growth company that will head towards this 100K delivery mark?
Yeah, I think you got to look at it as a disruptive technology company, not as a traditional automotive company. It's obviously a big part of the emotional bull-bear battleground on it. But to me, it's a disruptive technology stock, and that's how the street values it, at least where we are today.
All right, speaking of another different area of disruption, and that's the streaming wars. You're seeing clear winners and losers. When you like Disney, that could disrupt 10% of Netflix installed base, you suggest, in your number 5 prediction for 2020.
Yeah, Netflix owns streaming. No one will argue that. The call really is that Disney's going to have a more disruptive impact than I think many had expected. And I think that started to play out. But I think when you look at it, it could force Netflix to lower prices on the low end of the market. But I continue to think you look at Disney, Peacock, Apple, streaming wars, it adds, a lot more content out there and competition. That's something that's going to continue, I think, manifest over the next 6 to 9 months.
Okay. All right. Prediction number 8 was about the stalwarts like Google, Amazon, and Apple further expanding into 2 verticals, healthcare and banking. So this is kind of exciting because, we know that these companies have the capability. They've got the cash. They've got the vision, long-range plans. That in that prediction, I see how, tech just keeps going as these monoliths expand their empires.
Yeah, and I'd say, look, the only bit of caution, which is well documented, is that there's going to be more scrutiny as the big tech players further expand, more scrutiny from the beltway. And I think that's something that's going to continue to be a theme, just given the strong getting stronger. And I think you even saw that during earnings season with big tech.
Right, and that was actually your number 2 prediction, was that you see the regulatory headwinds could result in fines, but you don't see any business model changes, like Washington's not going to come down and start breaking them up this year at least.
Yeah, that's our thesis. I mean, especially covering Microsoft through late 90s, early 2000s, them going through the antitrust issues. I continue to think it's fine. Business model tweaks. Maybe it slows down M&A, but I don't see breakups. I think more fines, and that continues to kind of be our call in terms of why we continue to be very bullish on big tech and not necessarily shied away from some of the regulatory black clouds.
Yeah. Okay, last prediction we'll share because I know you got to hop soon. Number 10 was Google and its major cloud initiative, GCP, which is Google Cloud Platform, will potentially make a major strategic acquisition of a public cloud vendor, and obviously because they're chasing Microsoft and AWS.
Well, that's really it. I mean, Kurian, who I think has done a great job at Google in terms of on GCP. Now, I think an acquisition could potentially be in the cards as they go after Amazon, AWS, and Microsoft and Nadella. Now, in terms of who they acquire, that remains to be seen. But really the call is that, look, they could get more acquisitive on the cloud, and that would be a smart move if they do. And they might not do it with just one large deal. It could be a number of smaller deals. But that's just something that we kind of see for Google, for them to aggressively go after cloud, being a number 3 player today.
All right. Dan, I know you got to run. Lots of earnings coming out this week and other appearances. So really glad to have you on Mind Over Money and talk about the big disruptive trends and how we can make money on them over the longer term.
Hey, look, and thanks for having me, and I really appreciate being on.
All right. We'll talk to you soon. Dan Ives of Wedbush. All right. That was a great talk with Dan Ives, an excellent technology strategist who, called for a 5 to 7% rally in technology in December, and we got 12% here into early February, and he sees this thing as virtually unstoppable for another 12 to 18 months. So, I mean, that's easily NASDAQ 10,000, which was my target back in September, and probably NASDAQ 11,000. The last prediction that we talked about of Dan's was about Google, trying to catch up to Microsoft and Amazon. And I have some ideas there about what they could buy. And I'm going to name them, but I'm not suggesting that, this is all speculation on my part. I actually own these companies regardless of their takeover, whether Google is even thinking about buying them or there's any chatter, and there is no chatter. And these are companies that I call the big data miners and modelers. And the biggest one would be Splunk, which just crossed over to a new 25 billion market cap. Splunk, they've taught the Fortune 1000 how to access all their data, find it and make meaning of it. And they talk about dark data, where they just did a survey of 1,300 IT professionals and CIOs that firms feel like over half of their data is inaccessible. just because it's just being stored on servers, through log files and the internet and networks and sensors, and they'd like to be able to do more with it. And so Splunk is a company that helps them do that. Another one is Alteryx. The word alter, YX. So Alteryx is the way they pronounce it, symbol AYX. And they're about an $8 billion company, $9 billion now, that does a similar thing. They've got a platform that a data scientist can use, but also the person from marketing or sales or R&D can use the same platform, and they can mine and model different aspects of their data in a very intuitive dashboard sort of way. And then the third one would be Elastic, which is a company in the Netherlands that's very specialized. It's sort of like the Google of big data in letting companies search. So 3 companies, I don't know if they're on Google's radar, but I like them and think they could be. So that's just an example of where my thinking is there. All right. Really, just, I hope I made it clear by having Dan on and talking about his views of technology and what he's done with companies like Apple and Microsoft for the past 10 years. And he's been an investor and an analyst for over 20 years. He's worked at different companies. In fact, where did I thought I had his bio here. He's worked at, private technology companies and then come on to the investment banking side. But, in his work, he sees that, you have to be a long-term investor in some of these technologies that take decades to play out. So, we all lived through the NASDAQ bubble of 1999-2000 and watched, valuations go through the roof. But what's been different about this push higher in valuations is that the growth is there and the revenues are there and the earnings are there, and you see tech spreading out so that chips are for everything now. They're for mobile, they're for data centers, and Dan's really excited about the 5G revolution here. He calls it the 5G super cycle, and how that he says Apple will be the clear winner, but a lot of other companies will too. I mean, the semiconductors already have made new highs, even though the revenues and earnings have not made new highs. So that's investors anticipating what the 5G supercycle could be like. All right. Thanks for joining me today on Mind Over Money. There will be an article version, as always, of the podcast on Zacks.com. And what I do is it's not a verbatim transcript. I just summarize some of the key ideas, also put links in there to anything relevant. And so you can, and then you'll have all the stocks I talk about too. So, you can always, if in doubt about how to find my podcast on Zacks.com in the article version, you can just go to Zacks.com and type in one of the stock tickers I talked about. Let's say Alteryx, AYX, or Splunk, SPLK. Type that in, and then you'll get all the articles associated with that ticker. And you might have to scroll back through a couple, but then you'll see this article and in the Mind Over Money podcast. And I think that's all we wanted to talk about. All right, I'm sure there was something else, and it's just slipping my mind right now. But, they always tell me that I should tell people to subscribe to the podcast and leave me a review. I never do that. I never think to do that. So I'm just asking you, if you like the program and you listen, or you like this episode, subscribe on iTunes or SoundCloud, and leave a review too. I'd really appreciate it. And let me know what you think. All right. Thanks for joining me on Mind Over Money.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.